On 1st January 2006, the following balances appeared in the books. Machinery account appeared at rupees 8 lakh and provision for depreciation account 3 lakh 50,000. Now these are opening balances. On this date, the machine was sold off for rupees 2 lakh 50,000. That means this particular machine was sold off on the first date of the year itself for rupees 2 lakh 50,000. You are required to show machinery account, provision for depreciation account and machinery disposal account. So now students, let us bring down these two balances in these two accounts. These are opening balances. So on 1st January 2006, two balance brought down 8 lakh, and on 1st January 2006 by balance brought down 3 lakh 50,000. Now on this date, that is on 1st January 2006 itself, this machine has been sold. So as per the machinery disposal account, both these balances, that is the balance in the machinery account and the provision for depreciation account, should be transferred to asset disposal account. So on 1st January 2006, this amount would be transferred to machinery disposal account, 8 lakh here, and again this balance of depreciation account would be transferred to machinery disposal account as 3 lakh 50,000. After this, there is no other balance in these accounts, so they will tally out and there will be no balance remaining. That is, these accounts would be closed now. 350 here and 350 here. Now these postings, that is the posting on the credit side here and the debit side here, would be reflected in machinery disposal account. Since the machinery account has a posting on the credit side, in machinery disposal account this posting would be on the debit side, whereas the provision should be recorded on the credit side. So let us see how machinery disposal account would appear. Again, it is an account, so the format would remain same, that is the debit and the credit side, and you would write date, particulars and amount on it. This is machinery disposal account. The columns are same, the sides are exactly there as in the ledger accounts or the format. This is date, particulars, amount, date, particulars, amount. You can add journal folio to it as well. Now, the machinery account had a posting on the credit side, so it would be recorded on that very date, that is on 1st January, on the debit side to machinery account. That is, the balance of rupees 8 lakh has been transferred to machinery disposal account, and this balance of provision for depreciation account would be recorded on the credit side by provision for depreciation account 3 lakh 50,000. Now both these balances have been transferred here, so all the entries related to sale would now be recorded in machinery disposal account. This machine has been sold for 2 lakh 50,000, so by bank 2 lakh 50,000. Now students, let us calculate the profit and loss. The cost of this asset was rupees 8 lakh. 3 lakh 50,000 is the depreciation till date. That means book value on date of sale is 8 lakh minus 3 lakh 50,000 and it comes to rupees 4,50,000. An asset worth rupees 4,50,000 has been sold for rupees 2,50,000. So there is a loss which will be recorded as by profit and loss account, loss on sale of rupees 2 lakh, and the account would total out. There would be no balance remaining in this account. Remember, this account is opened for the day, that is the date on which the asset is sold, and is closed or balances out on that very date itself. In case there would have been a profit, it would have been recorded on the debit side. But in this case, there is a loss. So on credit side, profit and loss account, which shows loss on sale.